Most investors think wealth is built by choosing the right asset: stocks, crypto, funds. But what if the real difference between losing money and protecting it is not what you buy, but how fast you can sell it? Because here's the uncomfortable truth. The easiest money to move is often the easiest money to lose. So here's the real question. Are liquid investments actually giving you freedom or silently increasing your financial mistakes? Look at how modern investing works today. Everything is instant. One tap to buy, one tap to sell. Prices updating every second. It feels powerful, but something subtle is happening underneath. When access becomes instant, decisions become emotional. A small drop turns into panic. A headline turns into fear. A rumor turns into action, and most losses don't come from bad investments. They come from fast reactions. So the question is, if you can exit anytime, how often are you exiting at the worst possible time? Because in modern markets, speed feels like control, but often becomes loss in disguise. Imagine two investors. Both invest the same amount. Investor A uses liquid assets, stocks, crypto, fast-moving markets. Investor B invests in illiquid assets, real estate, long-term holdings. Now a market crash hits. Investor A checks prices every hour, sees red everywhere, feels pressure, sells early. Investor B sees nothing. No daily price update, no panic trigger, same market, different behavior. So what really changed, the investment or the ability to react? 1. Liquidity creates emotional reactions. When money is easy to access, emotions take over. Why do people make worse decisions when they can act instantly? Because speed removes reflection time. And reflection is where discipline normally happens. 2. Illiquidity forces patience. Illiquid assets don't update every second. Real estate, private equity, long-term infrastructure. What happens when you cannot react instantly to fear? You wait, you observe, you think longer term. And that delay often prevents emotional mistakes. 3. No price noise effect. In liquid markets, noise is constant. Every movement feels important. What changes when price noise disappears? You stop confusing movement with meaning. Not every drop becomes a crisis anymore. 4. Time becomes a filter. When you cannot exit instantly, time becomes your decision filter. What does time do that emotion cannot? It removes impulsive decisions, and most financial errors are impulsive, not analytical. So now zoom out. Modern investing rewards speed, but long-term wealth often survives through stability. Liquid assets give flexibility, illiquid assets reduce emotional damage. But here's the irony. The same system that gives you control also gives you constant temptation to misuse it. So is liquidity a financial advantage or a psychological trap in disguise? So what's the real takeaway? It's not about choosing one over the other, it's about understanding behavior. Liquid assets are not bad. Illiquid assets are not perfect. They do different jobs. Liquidity gives access. Illiquidity gives discipline. And most investors don't lose money because of the asset. They lose money because of how they react to the asset. So the real fix is not changing investments. It's controlling reaction speed. So here's the final question. If instant access to your money increases emotional decisions, is liquidity actually helping you build wealth? Or just making it easier to destroy it faster? Think about that. And subscribe to Wealth Insure Lab for more updates.